If global growth stutters in 2025, who will bear the structural consequences? And who still wins? The era of consistent 5% expansions is gone. We now enter a phase of low growth, heightened risk, and strategic recalibration. Major economies such as the United States and Eurozone are targeting growth nearer to 2%, while the international monetary system braces for shifts in power. This video explains the forces compressing growth and why they are reshaping the rules of global capitalism. If strategy and economics shape the world, make sure you're part of the conversation. Subscribe now and stay ahead. In the decades after 1945, the global economy enjoyed expansion, driven by rebuilding, innovation, and rising living standards. The 2008 financial crisis broke faith in unbounded credit growth, followed by a decade of ultra-low interest rates and high leverage. Now, mid-2020s, data show that many major economies are failing to return to previous growth trajectories. For example, advanced economies recorded an average growth of approximately 2% in 2024, far below the historical 4 to 6% band. In short, the world has moved from growth as default to growth as challenge. By 2023 to 2025, the convergence of three forces altered the global growth architecture. First, demographic decline and productivity stagnation constricted potential output. Nations such as Japan and Germany entered negative working-age population growth. Second, supply chain disruptions and energy shocks raised costs. In 2024, the global oil price spike cut potential growth by nearly 1% in manufacturing economies. Third, a shift in monetary fiscal coordination emerged. Central banks started tightening while governments maintained high spending, creating debt servicing burdens that acted as a drag on investment. These shifts created the turning point. Growth stopped being a given and became a strategic outcome. Analysts across economics, demography, and geopolitics broadly agree that three structural pressures define the 2025 global economy: demographics, debt, and decoupling. Demographics. The global workforce is aging. In advanced economies, the ratio of working-age adults to retirees is falling. This reduces labor supply, increases consumption pressure, and limits investment returns. Debt. Global debt to GDP in 2024 reached over 300% in combined advanced and emerging markets, according to the International Monetary Fund. The servicing cost of that debt eats into productive investment and forces policy trade-offs. Decoupling. As geopolitical rivalry deepens, the integration of global value chains is under strain. Firms face two choices: deepen efficiency or diversify resilience. The trade-off is clear and costly. This convergence of pressures means we are not simply facing slower growth, we are facing a world where growth itself must be earned anew. As we move into the next 5 years, the global economy may follow one of three strategic paths. Baseline scenario: low growth equilibrium. Growth stabilizes at around 2 to 3% globally. Structural reform continues, but gains are modest. Investment flows shift towards services and digital ecosystems, while traditional manufacturing lags. Reform-driven upside. Governments commit to structural productivity reforms, green transition, digital infrastructure, labor force integration. Emerging markets such as India and Vietnam accelerate growth to 5 to 6%, partially offsetting advanced economy stagnation. Inflation moderates and confidence returns. Stagnation shock scenario. Debt burdens, climate shocks, and fragmentation lead to growth below 1%. Capital flees to safe assets, investment collapses, and emerging markets suffer cascading defaults. The global economy enters a decade of muted prospects. In each path, the fundamental question is whether growth becomes the default again, or remains an anomaly. Three major structural risks stand out. First, productivity collapse risk. Without technological progress or human capital investment, economies may plateau permanently. Second, debt service trap risk. As borrowing costs rise and revenues stagnate, governments and corporations may divert resources from innovation to servicing past obligations. Third, fragmentation risk. As global cooperation weakens, 1/3 of trade could face new tariffs and non-tariff barriers, reducing global output by up to 5%, according to research from leading institutions. These risks are not spikes. They are slow-moving glaciers that can reshape the economic landscape without dramatic headlines. Quick reminder, hit subscribe if you haven't already. Let's keep going. In 2025, the global economy is no longer a rising tide. It is a contested frontier. The critical question is not whether growth returns, but who shapes the conditions that make it possible. Will the next chapter belong to those who reform, diversify, and invest? Or will it favor those who simply wait and hope? If strategy, history, economics, and finance shape the world, this is where they converge. Subscribe now and join the conversation.